Hey everyone, Richard Norris here, and in today's video I'm going to talk about my 5-step method to build a real estate property portfolio. Now, first things first, for those of you who don't know me and if you're new to my channel, my name is Richard Norris. I'm the founder of a company called propertyconsulting.io. I've built a multi-million pound property empire, and my group of property companies does over £250,000 per month. With that being said, and without further ado, let's jump in. So the main thing when starting a property portfolio that I do, and I advise that my clients to do when building out a real estate portfolio, is to use a model called buy, refurbish, refinance, repeat. And basically what this means is that every time I buy a property and I add it to the portfolio, I'm going to buy that property, I'm going to look to improve the property in some way, shape or form by doing a refurbishment, and I'm then going to recycle my money by refinancing the property. Because when I refinance a property in a limited company or even in the UK in your personal name, it's a non-taxable event, okay? So I want to be able to refinance the property, take my money that I put into that property back out, and it still cash flows. Now again, the key here is to understand that when you refinance a property, without getting into the granular micro details, holistically, when you refinance a property in the UK, it's a non-taxable event by HMRC under their rules and regulations. So that's like the fundamental truth of how to and thesis of how to build a property portfolio fast and how to scale it up. Now I'm going to break that down into 5 steps, okay? 5 key steps that you can implement. Now make sure that you don't skip any of these steps, okay? If you miss out any one of these steps, you're not going to get the best results, and I want you to get the best results. So make sure you stick around to the end to make sure you understand every single step in the process, the 5 key steps, the 5 fundamental truths to growing your property portfolio. So step number 1 is financial planning. So the very first thing that you need to do when you're looking at building a property portfolio is to come up and build your financial plan and build your financial model. Now, everybody's financial plan and everybody's financial model will be different depending on their earnings, depending on how much savings and capital they have, and depending on how much equity they have within existing properties, maybe in their own primary residential property, i.e. their own home, and their earnings ratio, as I said. So all of those things will be factors that you need to take into consideration when building out your financial plan and looking at how to grow the property portfolio. Now, I've kind of broken this down into 4 kind of key fundamental elements. So I'm kind of saying, like, anybody who has £0 to £50,000 in cash or equity, the fundamental strategy that I would get you to implement and that I get my clients to implement from the ground up at this level is what we call flipping or wholesaling. So what do we mean by flipping? Well, flipping a property is buying a property, adding value to that property by doing a refurbishment, and then selling for a profit. Now again, to keep this at a macro level or high level, if you're starting out and you're wanting to buy that very first property and you've got £50,000 of cash or usable equity that you can use to buy that property, as a down payment, we're going to take out 75% loan to value mortgage, and we're going to put the £50,000 into the property as A, deposit, and B, as refurbishment money to get the first deal done. Now, whatever I put into that property as a deposit, so let's say I buy a property for £100,000 and I put down £25,000 as the down payment as my deposit, and I use the other £25,000 or 20,000 of it to do the refurb and 5,000 for stamp duty, legals, etc., then that £25,000 deposit is what I want to double. Whatever I put in as the down payment in that property, I want to get out as profit. So if I'm putting 25k deposit in, my profit on my first flip wants to be 25k before I pay my taxes. Okay. The other strategy that I suggest that you go down, and the other route that you should go down if you're somebody at this level with up to 50k of cash or equity to start your property portfolio and build out that real estate portfolio, is wholesaling. Now, wholesaling is when you go out there and you find deals for other investors who are cash rich and time poor. You may go out there, you may be able to find deals, learn how to negotiate the deals, get the offers accepted below market value, package up the deal, put together refurbishment schedules, the project Gantt charts, present it to an investor, maybe even project manage the deal, and basically provide what we call a turnkey solution. Now, many of my clients that I work with are high net worth individuals. They're sophisticated investors in our back-end program. They are property millionaires, okay? And those people are often cash rich, time poor. So if you're coming in at brand new and you're somebody thinking, well, I want to get into property, but I've only got £50,000 of cash or usable equity, and maybe I need more money to start. Well, actually, the best thing you can implement is, if you're at the kind of lower end of the starting journey of a property portfolio and building that, then leverage your time and sell it to rich people. Okay, sell it to the people in my program that are rich, that already have a property portfolios, that maybe have tax problems, and go out and find deals for them. These people are good at making money, they may not be so good at keeping the money, and they may be cash rich, time poor. You're going to be the vehicle to helping these people, and as a result, you're going to get paid £5,000 to £10,000 per deal. So that would be my strategy of choice for somebody like yourself. The second type of person, maybe you've got between £50,000 and £250,000 of capital or usable equity to invest. If that's the case and you're looking to quit your corporate job and you want to build cash flow, I would look at the buy, refurbish, refinance strategy. Again, I'll be looking at finding those deals, buying below discount, adding the value, refinancing the money as a non-taxable event, and then moving that on to buy the next property, so on and so forth. And I always want to look to take as big of the money that I've put in out. Okay, so a better way to say it is I want to take the maximum amount of money that I've put into that deal back out, and it still cash flows within my portfolio. And then that will help you to leverage and grow and scale your property portfolio using that pot of cash that you've got. The other thing you can do if you're at that level with £50,000 to £250,000 of cash or usable equity is you can have maybe a 3-to-1 strategy. Maybe for every 3 properties that you rent out and you do a buy, refurbish, refinance model, if you leave some capital in a deal, and it can sometimes happen because the authentic nature of property is sometimes you might get a down valuation and you may leave more money in than you want to, then you're going to replace that with a profit utilization strategy over here. So you might choose to go and flip a property. So it might be like, I'm going to do 3 buy, refurbish, refinance properties, maybe HMOs, service accommodation, whatever your strategy of choice might be. And then the 4th property you're going to flip, like a 3-to-1 strategy. So you're constantly replenishing that cash. Otherwise, the cash pot is going to run out. Now, the third type of investor that we see, and you may be in this category, is anyone who's got £250,000 to £500,000 of usable cash or equity. Then you can start to scale a bit more aggressively. You would still implement the buy, refurbish, refinance strategy because that's the fundamental thesis that I have, and I have a very strong conviction that that's the way to scale your property portfolio. And it's been tested over time that people who have basically grown their property portfolios into multi-million-pound empires have always used that wealth creation vehicle, leveraging debt, leveraging against the assets to grow and to scale. Okay, they're not using a debt consolidation strategy, paying mortgages down and just putting down a 25% deposit and buying properties in a traditional way. That's not how this works. So if you're somebody who's got £250,000 to £500,000 of usable cash or equity, I would still implement that strategy as I said, but you may be able to branch out quicker into things like commercial to residential developments and basically take what we call office buildings and convert them into apartment blocks. So for example, I taken an office building, turned it into 11 apartments, and you have the choice at the end of the project with those 11 apartments, do you sell 5 and keep 6, or do you refinance them all and again leave it in your portfolio cash flowing, okay? But you can just go bigger quicker. Now, the next strategy that you might want to implement is if you're somebody watching this video, maybe you're a business owner, maybe you're an advanced entrepreneur, and maybe you've got more than £500,000 plus of cash or usable equity, then again, you can go and advance faster, quicker, and scale your portfolio in a quicker manner. And you may want to start looking at like land developments where you're implementing what we call a build to rent model. So for example, I have some clients, I've worked with one client called Lee Phelps. He's one of the fastest growing developers across Kent. He works with Homes of England, and he does a build to rent model. And what he does, he goes in and he buys up some land, he'll get planning permission, and then they'll like say build 20, 30 homes. And out of those 20, 30 homes, he'll sell some and maybe he'll keep some, or maybe he'll keep all of them. And we call it a build to rent model, where he's going in, he's building out the properties, and then he's refinancing at the end to pay back all of the loans and the debt. And he has all of these properties that he owns. So he's got 30 properties at the end that are new builds that he rents out. And then you get cash flow from that. So that's kind of like a bigger play. But those are really kind of the numerical values and the stages of growth as you go through a property portfolio and build a real estate portfolio, in my opinion, and from my experience of working with people at those different levels and the strategies that I see work best based on those individual parameters based on financial planning. Okay, so step number 2 in the process. Now you're familiar with your own financial plan, your own set of unique financial parameters, and you've got your financial goals in place and you know what you're going to execute on, and you've got the strategy, you then need to look at the area and the property type. So where are you going to invest and what's the property type that you're going to look at? So again, this will be depending on the strategy that you choose in step 1. So let's say that we're going down the HMO route. Well, we need to then find an area which is going to be good for HMOs, depending on the capital that we have available to us. Now, for some people, their benchmark KPI might be, I need to make 20, 25, 30% return from every deal that I do to hit £10,000 of passive income per month with the usable cash that I've got. For some people, the return on investment that they might need to make could be significantly less because they've got bigger starting capital to basically get to 10,000 a month. I.e., if you had £1 million and you invested £1 million and it made you 10%, that's 100,000 a year. But if you wanted to get to £100,000 a year and you didn't have £1 million and maybe you only had £500,000, well, then your parameter would be you'd need to get 20% return on your money. Okay, and so your area is going to be dependent on the return on investment that you want. You're going to be thinking about, am I looking for capital appreciation? Am I looking for cash flow? And quite honestly, the number one principle that I, as a property investor, opt for and is in my thesis is I want to invest for cash flow. The antithesis of that is that somebody will say, well, we should be investing for capital growth. And maybe the synthesis somewhere in the middle is, how about we invest for cash flow and capital growth and optimize for that? And that's probably where the truth lies, in the middle of the synthesis, in the thesis and the antithesis. The synthesis is we want to be investing for cash flow plus capital growth. And we call this the total return formula. So if that holds true, what we're going to do is work out what's the number one thing we're going to optimize for. And if we're optimizing for the thesis of cash flow, maybe we're going to go for a higher rent to low house price ratio, and we're going to invest in the northwest of the UK or the north of the UK, northeast, for example. If you're somebody who's got more capital and you need to get a lower return and you're happy to blend cash flow plus capital appreciation, maybe you can invest further south, southwest or south of the UK, or from anywhere from Coventry on the map downwards, really, as a geographical kind of benchmark in the UK, then that's going to help you to find your area. And you're going to go over and use tools like Rightmove and property data to find the average asking price, average house price, average rents for different property types based on the strategy that you've selected in your financial plan, your financial model, knowing the strategy that you need to hit your outcomes that you want. And then you're going to work out, okay, based on that, this is the area I'm going to invest in because I know that the numbers work. You've got to start making decisions on data at the micro level. And the biggest mistake that I see property investors make when they come in is they don't know how the micro numbers work. Okay, and so they end up just choosing an area or which is a place where they live because that's what they know. But when you actually run the numbers in that area, the numbers don't work to get to their desired outcome, and it takes them longer to scale the property portfolio, or they're just reliant on capital appreciation. Well, if we're always just reliant on capital appreciation and market conditions, then we're kind of placing a grand wager that actually the probability of success is less likely because we're reliant on market conditions, and the market can go up and the market can go down. So we're less in control. If I'm optimizing for cash flow, I can place a grand wager if I have the skill set, the knowledge, the financial perspicacity, the data, knowing that I'm buying properties in the right area, using the right strategy, and I'm getting the right returns, and I'm refurbishing those properties to product market fit, I have a much greater chance of success. And therefore I'm placing a wager that this outcome of cash flow in the portfolio, the desired cash flow that I want to achieve, is much more likely to be a reality as opposed to just relying on capital appreciation. So another big mistake I see people make, just solely relying on capital appreciation. And it does depend on your individual situation. It does depend on your unique set of parameters. It does depend on what your actual goal is. Are you investing for retirement? Are you investing to replace your corporate job? Therefore, income's the most important thing for you. But truly, if you're starting out and you want to scale a property portfolio as big as you possibly can, then the truth is that you're going to be optimizing for cash flow, number one, and capital appreciation as a secondary contributor. And the blend of those two over time, remember, we're playing the infinite game of business, and we're making decisions on delayed gratification as investors, not short-term instant gratification. Then finding the balance between cash flow and capital appreciation to give you that total return formula, and adding those two numbers together. When you understand how to do that formula, you're going to be able to understand that you get a higher return on your investment. And that's how you can make good decisions as a property investor based on financial literacy, financial perspicacity. You need to understand the maths and the data. So in order to kind of give you a quick example of how you'd work that out, well, your return on investment effectively would be your net cash flow. So let's say I had a property, high level, 2,000 rent, £1,000 of expenses going out, £1,000 profit, okay? £1,000 profit per month times 12 is £12,000 per year. And then I would do the £12,000 per year, and I'll divide that by the money I leave in the deal. So let's say for the ease of maths, I left £100,000 in the deal. Well, I'll do 12,000 divided by £100,000 gives me a 12% return on my investment. It's a low return, in all honesty, because remember, we want to take as much money out of the property as we possibly can. And in the best case scenario, we don't want to leave any money in the deal. But in this scenario, we're saying, well, we're leaving £100,000 in the deal of our cash tied up for just £12,000 of net cash flow per year. But in this scenario, just to give you an example of how to work this out so you can follow the 5-step framework and start going out there and implementing this for yourself and growing your real estate property portfolio, the second thing that you would look at is capital appreciation. So let's say that I brought a property, and in this example, again, it's quite an arbitrary figures, but just to make things easy and simple for you to understand, I brought a property for £100,000 and it makes me £12,000 in cash flow, as I just said, and it makes 5% in capital appreciation. So that property goes up by £5,000 per year. So I take the £5,000 per year of capital appreciation, add it to the £12,000 per year of net cash flow, which means that I actually make £17,000 per year. And I divide that by the £100,000 left in the deal. My 12% goes to 17% based on a combination of cash flow plus capital appreciation, which is my total return formula. Okay, and that would be how you would select your area. Okay, you're going to select your area based on numerical data first and where the numbers work. The second way, you're going to choose the area where you want to invest in based on strategy type and based on tenant demographic, tenant demand, concentration, saturation levels. Okay, if we're doing build to rent, well, we need to know, well, are we going to build 2-bedroom properties? Are we going to build 3-bedroom properties? What's the ratio on a scheme of 30 properties? How many are 3-bed? How many are 2-bed? Are we going to build some apartments? We need to define all of that. And the way we define all of that stuff is based on A, the area, but secondly, the end buyer. So we need a set of data. We need to understand, what do people want? We call it product market fit. What do people want to buy in this area? What is selling? What is the most transient sales at the moment in this given period, in the time frame that we're going to build to sell? Okay, so I just wanted to get you thinking about these things. It's the same way if you're going to hold a property and rent it out, and you're going to rent out a 5-bedroom HMO. Well, you need to know that the area is either close to universities, close to local hospitals, has a good infrastructure, there's good local transportation. You need to understand your end user, the end tenant demographic, and you need to understand what they want in order to be able to fill that property with predictability. And then you build to the market needs. Okay. The next thing I want to talk about in step 2 actually as well is lead generation, because the biggest thing that you need to understand as a property investor is not only where am I going to invest after you know the strategy, is you need to know how to find off-market deals and buy at a discounted price. So you need to understand, okay, now that I'm going to go out and find either land or a commercial property that I'm going to convert into flats, or I'm going to buy a 3-bedroom property that I'm going to convert into a 6, 7, 8-bedroom HMO, or I'm going to buy a 2-bedroom property which is a mid-terrace, right, in X area, could be Wales, wherever. You need to say, how can I go and acquire these properties, the specific property type that I want to buy that fits my predetermined, personal, defined set of parameters to get me to the goals I want, to build the property portfolio in the desired time frame that I want. What does my lead generation strategy look like so I can find the right property in the right area that's going to give me the returns that I want? And we're going to execute on that. So it's all about getting very laser focused and building this in a business-like manner with perspicacity and data at the heart of every decision that we make, as opposed to guesswork. Now, a lot of people in the space, again, I don't want to be defamatory, but a lot of people in the space, the data is that 98% of landlords across the UK own just up to 2 properties. Okay, and so if that's the case, they're probably not operating this as a business, and they're not following these fundamentals, which is why they can't scale their property portfolio past 2 properties. Okay, so that's step 2. Step 3 in the process is financing structures. Okay, so when we build out the property portfolios at propertyconsulting.io, when I build out my own property portfolio, when I build out the portfolios for our client, I have a spreadsheet which has lots of mathematical algorithms in, and I want to track all of my investments, okay? And I want to run every financial variable using data and maths to make my decisions. That's how I truly make my decisions and get the best return on my investments. Because I think sometimes people forget, when you're building a real estate property portfolio, the biggest skill set that you need to become good at is you're an investor. Therefore, you need to be good at investing, and good investors make decisions based on data. So we need to look at the financial structure to the business. And what we need to do is look at 5, 7, and 10% interest rates. And within the portfolio, we want to say, okay, based on a number of variables that could affect my returns on investment, i.e. the occupancy levels. If the occupancy levels drop from 100% to 80% in an HMO across any given time period, what does that look like at today's interest rates on my loan to value at 50%, 60%, 70%? What does that look like at my loan to value 50, 60, 70%, but at 7% and at 10% interest rates? So we're looking at market fluctuations, because the last thing we want to do as a property investor is nobody wants to be in a position where we hit a recession, and we know that they happen. We had the financial crash in 2008. We've been through the pandemic of COVID in 2020-21. We saw what happened to interest rates. We saw the base rate go from 0.25% to 5.25%, okay, in a very short period of time. I think it actually may have went up to 5.75% at the highest. But we basically saw like a drastic increase in the base rate. And at that time, when your interest rates are rising, we had clients that were coming off fixed terms and going on to variable mortgage rates, and they're paying 8, 9, 10%. So we know that we must, based on past data, which is usually a good indicator of what happens in the future, we know we're going to enter into this cycle again. So when we're planning and building our real estate portfolio, we need to future plan based on worst case scenarios, worst case financial downsides. And if you always manage your property portfolio and look at the numbers on a worst case financial downside, stress testing your properties at 5, 7, 10%, you can even go all the way up to 15% if you want. And you have a system that tracks different variables, i.e., like I said, the loan to values and fixed terms, 1 year fixed term, 2 year fixed term, 3 year or 5 year fixed term mortgage rate. And you have a system that can also track what happens if the occupancy rates drop from 100% across the portfolio to 75%, to 60%. And you can truly say, well, I know across my portfolio, hypothetically, fictitiously now, for the purpose of this video, I know at 50% occupancy rates and at 10% interest rates, at a loan to value of 60% or 50% on my portfolio, I'm at break even. You now are playing the game of being a great real estate investor, because you know your numbers inside out. You're able to manage the downside within your investment portfolio, and therefore you're playing a safe wager. It's like going to the casino and kind of knowing when you're playing 21 or blackjack, knowing like what the other person's deck is, right? It's kind of like you have an unfair advantage. You're creating a bias within the business. And that's how I look at this. I look at the whole portfolio. I don't just look at the individual deal one by one. I look at the individual one by one, and then I add that into the global P&L sheet of my portfolio, and I have all of the different algorithms to track every single variable and every single market condition and event that could possibly happen within the realms of being a real estate investor, looking at past data, and we put that into the model, and we look at it across different variances, and we run those different parameters. And as long as we're managing that financial downside and we can still see profit or still see at least a margin at 10% interest rates and what we call a debt coverage, a rent affordability check, my key performance indicator, the parameter that I like to track, is I want to be at 125% of a debt coverage ratio at 10% interest rate. That basically means across my entire portfolio, I want to see that, assuming, number one variable, assuming 100% occupancy across the portfolio, that the rent is 125% bigger than the mortgage interest payments across the entire portfolio at an interest rate of 10%. If I've got that locked in, I'm pretty healthy. I'm not 100% recession proof, okay? But I'm placing a grand wager that actually this is a very secure investment and it's gonna be okay during the downtimes. And of course, if I'm playing that game and I'm being that astute with my investments and I'm planning ahead, when everybody else is in trouble, And unfortunately, they may have gone into negative equity, they've gone into arrears, they're having to subsidize their mortgage payments, they're having to put money into the portfolio to reduce their loan to values, they're having to find cash to pay down the mortgage balance because the numbers no longer work. I can go in and find motivated sellers because I'm ready. Maybe I'm cash rich at that point. My portfolio is still cash flowing at 10% interest rates. Not many people would be able to sustain that. I can now go in and buy at a discounted price. So when the masses are fearful, as Warren Buffett says, I'm digging for gold. And just being frank with you, that's what I did during COVID. I was buying properties straight off Rightmove that was £750,000 in Oxford, and I was buying them for 675. £75,000 off of the asking price because of all of the market conditions made it favourable and easy for me to do that. It's actually very difficult to get a good deal in a good market. When interest rates are low, what happens? Everybody wants to be a property investor when interest rates are low. When interest rates are high, what happens? Nobody wants to be a property investor. But actually the truth is, if your business is based on high interest rates or low interest rates, you've got a seasonal business, and I would argue that you don't have a business at all. That's what separates the sophisticated investors that go out and grow multi-million pound property portfolios and become very, very wealthy. And these people down here who those landlords that are accidental landlords who have one or two properties, they don't know how to control the variables within a real estate portfolio. So you've got to get the finger on the pulse to your finances, and you've got to understand those financial structures within the business. So step number 4. Step number 4 is probably the most critical step in the whole process. And if you've studied my videos, it's something I talk about a lot, is tax. Okay? It's not about how much money you make that's important. It's only important how much money you keep, and not the money you keep that you can multiply. Your tax structure is the number one thing that's going to help you to scale faster. Because if you can keep more of your rental profits using legitimate deferred tax allowances under HMRC's legislations, and you know how to navigate around your tax structures in the UK, and use real estate to do that, to create the wealth and reduce your taxes, you'll be able to keep more of your rental profits. And therefore, if you keep more of your rental profits, guess what? You can then reinvest those profits back into buying more profits, and you create that compound interest curve, which is what Albert Einstein said is the 8th wonder of the world. He who understands it earns it, he who doesn't pays it. And a lot of people honestly don't understand property taxes. They say property is no longer tax efficient, and I understand. But when they say property is no longer tax efficient, they're talking from a place of like mass media. Buying properties in your own name is not tax efficient. I would agree with that, okay? I would agree with that conviction. I would agree with that thesis that buying any type of property investment in your personal private name in the UK is not a good move. You're going to pay inheritance tax at 40% on the estate. You're going to pay 24% capital gains tax on disposed of the assets in the future. And you're going to be taxed as if you're a high rate taxpayer, which is what we want to be. We want you to be a high rate taxpayer. We don't want to cap our earnings. We want to be financially independent, remember. The goal is to grow the real estate portfolio as big as we possibly can and pay as little taxes as we can. So if we're playing that game, we don't want to be capping our earnings at £50,000 per year. So when we become a high rate taxpayer, we enter Section 24 finance restrictions, which are the punitive tax legislations that have been put on private landlords in the UK, and we can no longer offset our mortgage interest rate. We only get a 20% relief at the end. So I agree, buying property in your personal name makes no sense. But what about if I told you, based on your unique personal situation, and again, everybody's parameters are different. So everybody watching this video is going to have a different set of tax parameters based on their goals, based on their family, based on what's important to them. Now for me, what's important for me and what I see for a lot of our clients is I want to build wealth through real estate. I'm building wealth through real estate, and I'm going to continue to build wealth through real estate as an investment vehicle because it's been proven to perform time and time again. Okay, so I feel it's a safe commodity that I can touch, that's tangible, and I know people always need a place to live. So knowing that to be my thesis and my conviction around that, and having such a strong conviction around that, and having the knowledge and the perspicacity and the wisdom to control events, which I can control within the business, which I talked about, the funding structures and the financing structures in step 3, I know that as long as I get my tax structure right, then I'm going to have a pretty good life. I'm going to build a profitable real estate portfolio that's going to last the test of time. And for me, what gives me purpose, what gives me contribution, is I want to pass a legacy down to my bloodline, to my future kids, my grandchildren, my beneficiaries, and my loved ones. And so I know that I can do that if I set up what's called a family investment company, which has freezer shares, growth shares, and a discretionary trust within the business. That means that all future investments that I make, I know are protected for my loved ones and beneficiaries, so that on my demise, there's only two things you can guarantee in life. One is death and one is taxes to some extent. I would argue the taxes one a little bit, but death and taxes, let's say. So I know on my demise that I can avoid my family having to pay inheritance tax if I purchase the properties in the right tax vehicle in the UK as a UK property investor. I also know from doing this and being around some of the smartest tax advisors in the UK that you have a lot of deferred tax allowances that you can use when growing a property portfolio. One being that if you buy properties in a limited company structure, straight away you can offset your revenue expenses. So if I keep refurbishing properties, keep adding value to those properties, I get both capital and revenue expenses that are allowable tax deductible business expenses within my portfolio. So what I do as a property investor, and this is why I always use the buy, refurbish, refinance model, where I talk about refinancing properties because it's a non-taxable event in a limited company. And I also talk about rolling over your investments, i.e. what do I mean by that? So I've just done a development, I've bought a property, added value, refinanced it, spent 100k on refurb. When I pull that money back out, I'm then going to go and do the same thing again. So I spent 100k refurb over here, maybe I spend 200k refurb, then 500k refurb. Well, if I add all those numbers together, that's 800k in refurbishment costs, and let's say 600k of that is a revenue expense. Well, I can offset all of that against my profit and loss statement for the year in my company. Therefore, I've got 600k of tax allowable expenses that I can offset against my corporation tax bill at the end of the year. Now, I don't know any other business that gets those sort of reliefs. So in my opinion, property is one of, if not the most tax efficient structure or tax friendly structures in the UK actually, when you break it down and you know what you're doing with the right tax people, okay? So if we keep following that structure, we're able to grow the business, reduce our corporation tax bills, and still cash flow 10, 15, 20, 30,000 pounds a month from our investments. And at the end, we have little corporation tax to pay. Okay? So that's what I want you to understand and take away from point 4 is you must get the right tax structure in place. You need to invest in a great tax consultant, a great set of lawyers and barristers, and an accounting practice. By the way, for those of you who are being introduced to me for the first time, who don't know me, propertyconsulting.io is my one-stop shop. We have tax barristers, we have lawyers, we have chartered accountants. I own an accounting practice. This is why I'm very au fait with how property taxes work, and I'm pretty good at keeping my money. So if you're somebody who wants to play in real estate, I'd advise you get yourself around a good set of advisors and a good team that can help coordinate that tax structure based on your personal individual situation and the goals that you want to achieve. So last but not least then, step number 5. So step number 5, and one of the keys to growing your real estate portfolio, is knowing when to sell and when to hold, okay? Now, how do we determine when to sell and when to hold? There's a number of variables that will affect this. But my overarching opinion is in some instances it can be very obvious, in some instances it can be less obvious, okay? So we'll start off with an instance where it's an obvious one. So if I've bought a property and it's very profitable and it's basically producing me cash flow every single month and it's a cash cow, and I've got like an infinite return on my investment, so the property doesn't owe me any money back, and it's constantly full, it's performing well, it continues to perform well, then logically, from first principles, you're not going to sell that property. You're going to keep it in the portfolio. However, with that being said, I have a saying within my life, which I learned from a multi-millionaire, okay? A very, very wealthy individual who had a property at the time that was worth 55 million pounds. I remember saying to them, hey, you'd never sell this property, right? Because it was amazing. Beachfront property, car showroom, all this stuff. And it was just like incredible. And he looked at me and he said, well, of course I would. Everything in my life is for sale, Rich. Everything. Everything that I own is for sale at the right price. If somebody offered me 70, 80 million for this property, I would sell it and go and build two. So my key takeaway for you as a real estate investor, when you build your property portfolio, you need to be making decisions on, a lot of people in the UK just say buy properties and then wait and just hold forever. But that doesn't hold true when you look at mass on a micro level. So I'm going to be of the antithesis to that thesis. I don't think that thesis holds true. It doesn't make sense when you break down the maths to hold that property forever and just let the asset keep appreciating. Because when you do that, you build up a ton of equity in the property. And from what I've seen firsthand of working with clients in this situation, is they may have bought properties 20 years ago for say £90,000. Those properties are now worth £550,000. Cool. They've had like £460,000 worth of capital growth. Great. They've made a lot of money over 20 years in capital growth. When you look at the cash flow and you look at the return on the equity, they've got a ton of equity left in the property and they're getting low returns. And the reason that this happens, just so you understand cause and effect, the reason that this happens is because the rent on that property hasn't gone up over time in line with the capital growth. So they end up with a property that's a high value property with a low rent ratio. And therefore, if interest rates rise, for example, like now at 5%, when back in the day they might have had a mortgage on an interest payment of say 1.89%, well, it no longer cash flows as well anymore. Okay, so I'm going to give you a real example to break this down, because I don't want you to be one of these people that's like, well, I'm just going to buy an asset, refinance it and leave it forever more. We need to be a bit more perspicacous than that. We need to be a bit more shrewd, and we need to be thinking a bit more like a businessman with business acumen, or a business person, I should say, to grow the portfolio and know when to buy, when to sell and when to hold. Okay, and this is the point where I would sell. So I'm going to go into a client case study here, and I'm going to talk you through this client case study, and I'm going to go through the notes that I've got in front of me here because I want to get the numbers right. This is a true live case study that I'm working on right now, okay? And here's a practical example. The number one thing I want to say to you in this example is I meet a lot of clients in my back-end program that own properties in their private name, okay, or jointly husband and wife. And in this scenario, it happens to be husband and wife that own 5 properties in their joint names, okay? And the first and foremost thing to realize is it's in the wrong tax structure. They're higher rate taxpayers, okay? And so if you've got tax liabilities, huge tax liabilities, you have an option to sell. Doesn't always mean that it's the right thing to do. We have to look at the micro analytics to see whether that holds true. But I'm going to give you a situation which is extreme. It's a situation that's like, well, this becomes like almost like an obvious no-brainer to sell. But if I told you before I go into this situation, well, if this client disposes of their portfolio, the 5 properties, they pay £200,000 in capital gains tax, you're going to say, well, it's crazy to sell. Well, on a macro level, yes. But when we look at the micro level and we go deeper with the magnifying glass and we look at the numbers, things start to make a bit more sense. So let's go into this. So in this situation, my client had 5 rental properties, and the 5 rental properties, again, as I said, husband and wife, jointly owned, were worth £1,545,000, okay? They had an outstanding mortgage balance on the property portfolio of £610,341, so the net equity in this position is £934,659, okay? And this client in this situation was making a loss on the 5 properties of £10,804 per year. So they were actually needing to find £10,804 per year to subsidise these 5 properties that were owned in their own name. And this was mainly due to the punitive tax restrictions and legislations that were brought in by George Osborne in 2016, where if you're a high rate taxpayer, you've got to pay 40% on the gross rental income, and he termed it Section 24, as I've alluded to several times prior in this video and in other videos. It's a big problem, okay? So if you look at that 1 minute as like first principles, fundamentals first, I've now got £934,659 sat in a bank account, and it's almost saying from financial perspicacity that let's turn this into Barclays Bank. I've got £934,659 in Barclays Bank, and it's costing me, I've got to pay Barclays £10,804 per year for them to keep my money on deposit. Doesn't make any financial sense, right? Clearly something's wrong. Now we could restructure that out by releasing equity, or we could sell. So the first one, if we release the equity, we're choosing to hold. The second option is choosing to sell. So which one makes sense? Well, we need to go deeper again. If this client in this unique situation chooses to sell the properties, they pay capital gains tax on disposal. The capital gains tax on disposal is 24% because they're high rate taxpayers. And after they've kind of done the capital gains tax calculation, which we've done for them, took off all of their purchase costs, their capital improvements and everything like that, and used their nil rate allowances, they were left with a tax bill of £199,236. But after calculations, after sales disbursements, after early repayment charges on the mortgages that were fixed in, and after the capital gains tax, they were left with £703,067. So in this situation, they've sold 5 properties that are making a loss of £10,000, and they exchanged that £934,659 of equity for £703,067 of cash back in bank. So the equity position's gone down by sort of 240k. Now you might be thinking, well, why would you do that? It doesn't make sense. I've lost nearly £250,000. But here's the big part of the puzzle that you need to understand, and why in this situation, in my opinion, I would recommend that selling the properties would be a great option for this client. Because if we sold in that situation and we took £703,067 of cash into our personal bank account, paid the capital gains tax, we can then set up what we call a family investment company, and we can put the money into the family investment company as a director's loan, okay? That gives us a great deferred tax allowance under HMRC's rules and regulations. That £700,000 goes in as a director's loan. We then use that money to set up the smart company structure or family investment company structure, so we pay no inheritance tax on all future assets. And on the existing assets, remember, one thing I didn't tell you was that this client had a huge inheritance tax liability of around £120,000-ish, okay, from memory, about £120,000 of inheritance tax due on the 5 properties that they owned in their personal name. Across the estate, including their own home, they actually had an inheritance tax liability of above £150,000. So when we dispose of these assets and we bring the cash into the company and we buy new assets with that money, all future assets are not exposed to inheritance tax anymore. Previous properties were always going to be exposed to inheritance tax properties if we left them in the personal name. So we reinvest the £700,000, and if we make 20% return on the £700,000, which is exactly what we're going to do. If you work with me, I can almost guarantee that you're going to make 20%, because if you don't make 20%, you're not following my model. You're not following the results all of our clients have got. I have enough conviction, and I've worked with thousands of the clients over the years to know that 150% you can get above 20% return on your investments using a buy, refurbish, refinance model if you know what you're doing and you're a professional property investor and thinking about this in the right way and making decisions how I'm talking to you about how to make decisions in this video today. So we reinvest the £703,067, and at a 20% return, that makes us £140,613 per year of net profit. And in this situation, the client would have 5 years of deferred tax allowance to use by drawing out income from their properties of £140,613 net per year, which is £11,717 per month, tax-free for 5 years, because they're able to draw down on the director's loan account. So in this scenario, the client is now making an extra £151,417 of profit per year. Because remember, originally on these 5 properties, they were making a loss of £10,800 a year. They're now making a profit of £141,000 a year, technically on the same money, the £930,000 equity, even though they gave away £240 in the beginning to then reinvest a smaller amount. Now that is financial literacy. If I'm going to make an extra £151,000 per year by selling the 5 properties and reinvesting, then I'm going to make that move every day. Because if I do that once, that's one move. That one move made me an extra £151,000 a year today in the next 12 months. Well, over 10 years, that's now £1.5 million I've made on one decision. This is how you win at life, guys. If you compound that financial decision and you keep making good financial decisions like that, looking at the micro level, guess what? You do that 10 times, I've now made you £15 million in net worth. This is how you get rich. This is how you become a property investor and grow your real estate portfolio. It's knowing your numbers at a micro level, knowing when to sell and when to hold and when to buy. The other thing that we can do in this situation, which is something that's really smart for our clients, is for those of you who are a bit more astute, a bit more au fait with how this works, you may have this question. You may say, well, Rich, well, that's great. You've paid the capital gains tax bill you haven't really solved the inheritance tax bill yet, because that £700,000 that sits in the company as a director's loan account is still part of your client's account. And I'm going to say, yeah, sure, you're absolutely right. These two clients happen to be 63 years old. So let's place a wager, because everything you do in life is you're placing a wager. So if they're 63 years old and we know that they're in really good health, which is the truth, which is the case, well, we got £700,000 that needs to be drawn out into their personal name as earnings, tax-free, or in any capacity over the next 10 years, they could draw out that 700 and they could spend it on holidays, cars, whatever they want to do, travel, buy a home for their kids, whatever they want to do with the money. They're now going to deplete that £700,000. It's now out of their estate. There is no IHT due. Now, if the client's older, we have this sometimes, where the client's older. We have our oldest client's 85 years old, a director's loan account above £1 million. Well, in that situation, all we're going to do is we're going to gift the benefit of that director's loan account away to the beneficiaries under the 7-year tax rule. And we're just going to hope that the client lives more than 3 years. Again, we're playing the wager of life. And we either give all of that director's loan account away, or we gift any proportion or any percentage of that director's loan account away. That's also how you deal with an inheritance tax problem within an estate, to get really micro, really granular with this. You can see that a lot of this comes down to financial acumen, financial perspicacity and planning. When you understand how to look at a portfolio and analyse the metrics and the data in that way, you now know when to buy, when to hold, and when to sell. And like I say, in summary, I think I'm repeating myself here, but just to kind of reiterate my point, one of the reasons you would sell is often this. If you look at your portfolio in 20 years from now, like I said, I often see and work with clients that have bought properties, say, 20 years ago. And like I said, the property is appreciated in value by a lot, but the rental income is not appreciated at the same rate. And that causes a big problem in the portfolio. You see return on equity of like 2, 3, 4%. So the money's not working as hard as it used to be working. So therefore, we want to redeploy that capital. So it makes sense to sell, right? If I can sell and get that 4% now working at 20%, I'm going to make that decision all day long. Don't be emotionally invested to assets that you're buying when you're building a real estate portfolio. You need to think about things logically and have emotional detachment and make your decisions based on numbers. I just want to share with you quickly a little personal story from me, for those of you who are getting to know me. This is one of the first properties that I brought, and it kind of alludes to some of the situations of when to buy and when to sell. So this is a property that I bought back in March 2017. It was in Stockport. It's a 3-bed property that I converted into a 5-bed HMO, and it was on the market for £190,000 at the time. And I managed to purchase this property after following the property online for 6 months and using a good deal sourcer that I work with. We were able to buy the property £50,000 below the market. So we got a 26% discounted price on purchase. So we purchased it for £140,000, 50k below. And we spent £40,000 on the refurbishment, and we basically changed it from a 3-bed to a 5-bed property and did a single-story extension on the back. Again, it's in Stockport, so refurb in 2017 was a lot cheaper than refurb costs are today. And the GDV on refinance, the gross development value, or otherwise referred to as the done-up value, was £195,000. I remortgaged the property, pulled some money out, left some money in, and I was actually able, back in 2017, with Kent Reliance, they were offering 85% loan to value. So I maxed out my loan to value at 85%, and I took a mortgage of £168,732, which is actually 86.6%. That's because the arrangement fees that get added to the loan. Now, this property still sits in my portfolio today, and this is what I want you to understand, because this is quite powerful, this next bit. It currently rents for £2,592, 5 tenants, 5-bedroom HMO. The interest-only mortgage payments are fixed in on a 5-year fixed rate, and they're fixed in at 5.16%. So I'm paying £726.03 per month on the mortgage payments each month. I've got a management fee at 10% of the gross rent, which is £259.20 in management fees. And our monthly operating expenses, so gas, water, electric, council tax, buildings and contents insurance that we pay monthly, equates to £639.29 on this property, which is about 25% of the gross rent. And the net cash flows, therefore, the 2592 minus the mortgage of 726 minus the management fees of 259 minus the monthly operating expense of 639 gives me a net cash flow of 967.48, so £967.48 per month. Now, the current value of this property is 280,000 based on evaluation in June 2024. So I've seen on this property, I've seen capital growth of £85,000 and my equity position on refinance. Remember, on day one refinance in 2016, after 6 months of refurbishment, when I first refinanced the property, I took out a mortgage for £168,732. Remember, I refinanced the property at 195. So if you do the 195 minus the 168,732, you end up with an equity position of day one of 26,268. Now, I've just left that property to grow over the last 7 years, been collecting cash flow of around about £1,000 per month, so £12,000 per year, times that by 7, we're at like £84,000 a year of net cash flow that this property has paid me. And my equity position on this property has moved from £26,000 to £111,268 over 7 years, okay? So, and the loan to value started on this property at 86%, and the loan to value on this property now is 60%. Without actually paying down or reducing the mortgages or debt consolidation strategies, I've just let economics do what economics do. I understand the fundamentals of inflation. I understand that property is an inflation hedge, and that over time, my debt on a property is going to erode. That same amount of money due to inflation is not worth the same as it was 7 years ago. And that 168 is now 86%, was 86%, is now only 60% because the capital growth, the property's gone up in value. So I'm actually reducing my risk all the time just by buying the assets in the right area where I'm getting good cash flow and good capital appreciation. So this is an asset that I'll hold for now. But in the future, 5 more years from now, might be worth, say, 350 potentially, mortgage of 168. I have an option. Do I refinance it, pull the equity out and go again? Or do I sell it and cash in the profit and roll over the deferred tax allowances on revenue expenses for the P&L because I bought it in the right tax vehicle in a company? That's a decision I'll make in 5 year time. I can't make that decision today, but on today's numbers, it doesn't make sense to refinance it, pull the cash out. It just makes sense to leave it. So these are the decisions that you're always going to be making as a property investor as you scale your property portfolio. I hope this video helped. If it did, and you want to take action and you want to learn more about property, then click the link below. We have our program, Property Investors Accelerator, and another program called Quantum Property. You can work with us directly. If you want more advice about what to do, how to scale your portfolio, that's what we do. We help people to start and scale property portfolios. We've been very good at it. You can see our results online. And you can click the link below and you can book in a call with our team. And hope you learned something from today's video. And any questions that you've got, feel free to drop them in the comments and I'll get back to you. Thanks for watching, and I'll see you in the next one.